Hello everyone, welcome to Demand Supply Trading Practical Session number 34 for the year 2024. Myself, Srijit Kakar, and today is Sunday, 8th of September 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, the risk involved in the market, and also about the copyrights. Now, we have started with a WhatsApp channel. This is where we keep updating you whenever we have these sessions scheduled. Plus, if we have any other videos coming up or if we have any offers coming up, that is where we'll be sharing it with you. So, in case you're interested in joining the channel, you can scan the QR code which is available on your screen. Otherwise, the direct link is also available in the description. You can check the description, click on the link, and you can join this WhatsApp channel. All right, so today's session is practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available 100% free. And if you have not yet gone through the course, then do ensure you go through the course content so that you understand what demand supply methodology is. The links are available in the description. And the course is available in two languages, English as well as in Hindi. Now, when you go through the course content, you will be learning demand supply methodology theoretically, right? But unless and until you look into some practical examples, it's not very easy to start applying the methodology. And that is what we do in these sessions. So every weekend, I do one practical session where whatever we learned theoretically, we apply to some trading ideas to understand how to plan trades in a very mechanical and rule based way. Now, the beauty of these sessions is that we are not getting into something which has already happened. It's more like we're not doing any post-mortem of a trade which has already played out, right? The beauty of demand supply methodology is that we can always pre-plan the areas where we would like to be buyers and sellers, and that is what we do in these sessions. I plan these examples with you well in advance, and whenever in the future prices they come into these areas of demand and supply, that is the time these trades they get triggered. And it's not that I just do the analysis and then we forget about it. Whatever examples I'm sharing with you, whenever they get triggered in the future, we also review them, and that helps you build your confidence in the methodology. Because when you see the methodology working in real time, because real time in the sense we are doing the analysis in advance, and after the trade has played out we are reviewing it. So it's not that we are looking something which has already happened. And this is the beauty of demand and supply methodology, and this is one factor which definitely helps you build your confidence in the methodology, right? And that is why I do these sessions in such a way, so that you people build that confidence for the methodology, and then you start practicing it, and the more you practice it, the better you'll start getting with your analysis. Now, talking about reviewing these trades, like I said, whatever trades or examples that I share with you, once they get triggered, we start with the review of them. So whatever got triggered in the past has already been reviewed. We don't have anything which is pending. Therefore, we can start straight away with our today's practical example. Now, whenever we talk about trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. Title of that video is How to Start Trading. In case you have not yet watched that video, then do ensure you watch it. The link is available in the description. By going through that video, you will understand why it is very, very important that we should be a mechanical and a rule-based trader. And also what is the process which we should be following when we start trading, right? Because if you don't know the process and you're just randomly taking trades, and let's say few of those trades they get stopped out, we lose confidence, right? So that is why there is a process which you need to follow, and that video basically helps you in understanding that process and how it has to be applied. So do ensure you go through that process. There is no bypassing it. You might have to do that process maybe twice, maybe thrice. But once you have gone through that process quite a few times, what happens is you start leaning more against your rules and less against your emotions. So this is again a very common question that I get, that how can I become a trader who is trading purely based on rules and not based on emotions? So this is the process you'll have to go through, which that video will explain you. Now, since we need to be a mechanical and rule-based trader, what we need to do is we need to create a trade plan for ourselves. Now, when we start learning trading as a fresher, or even when we are learning a new methodology, what happens is due to the lack of experience in that methodology, it's not very easy to create a trade plan from day one. And that is where these documents that I've created for you, they help you in planning trades very mechanically and rule-based. So I have given you a ready-made trade plan, And this trade plan is basically a set of two documents. The first one is your trade plan steps. Now, again, I'll add, whenever I'm talking about some documents or some videos during the session, do not panic, right? How do I access these documents, or how do I access these videos? All the links are available in the description. Just go through the description, you'll have access to all these documents and videos. So like I said, it is a combination of two documents. The first one is your trade plan steps. You can also call it as the flow chart or the walkthrough. So this flow chart basically guides us what we need to do as a demand and supply trader step by step. Now, every step has its own elaborate rules, and those rules are available in the rule book. Now, minded, this rule book that I've shared with you is a conservative approach, because whenever we are learning something new, it definitely makes sense to start a little conservative. As you start having more and more experience, you start building up confidence. You can definitely make modifications to this trade plan to make it better suit with your personality style, because I do understand that every trader has a unique personality style. No two people are the same. Therefore, some modifications would be required eventually based on your experience. Those modifications can be done. So, what is my step number one whenever we start planning our trade? Step one is we need to define our trade purpose. Now, the question is, what do we mean by trade purpose? Trade purpose basically implies my expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So, when I'm talking about the exit, it's not necessarily I'm talking about profits, right? Exit can be in profit, exit can be in loss, exit can be break even, any kind of exit. So now the question is, why are we starting with the trade purpose? And the reason is, whenever we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We again follow a very logical process, and that logical approach is that the longer I want the duration for the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. That is why trade purposes are very first step, because once I have defined what kind of trade I would like to take, based on that I'll be deciding my time frames. Now what I've done is I have divided these trades into four different purposes. We call them as hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, that I'm pretty sure all of you would have experienced, whenever the market opens, some symbols they'll gap up, some symbols they'll gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, by keeping the position overnight, we are taking that inherited overnight gap risk which cannot be avoided. And that is why my recommendation to all of you is that initially your hourly dailies should be done as strictly intraday trades. Don't keep them as overnight trades, because that will add that gap risk to it. Now, when we talk about weeklies and monthlies, anyhow, we are not expecting to get the exit the same day. So here we have no choice. We'll have to keep these positions as overnight positions. But that does not mean that for weekly, monthlies, you cannot have gap against you. It can still happen. But since we are leaning against a bigger time frames, the probability definitely reduces. Plus, for weekly, monthlies, your zones are also a little wider. So even if you get a gap, that zone being a little wider zone might absorb that gap, and the prices might gap a little deeper into the zone versus gapping beyond the zone, right? But we can still have gaps for weeklies and monthlies as well, though the probability reduces. But as you start having more and more experience, you start building your confidence. If you want to include daily incomes into overnight trades, it can be done, because by definition, daily income implies a trade which can last for a day or few days. So step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to rule book page number 28, we start with the topic, which is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. Now, what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF. intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits, and the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the four different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my four different time frames? We get the answer from this table. Like in this example, I want to plan monthly income trades. So from this table, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame used for curve analysis. Weekly will be the intermediate time frame used for trend analysis. Daily will be the lower time frame. That is where we get our ACTS from. ACTS stands for stop loss entry target and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Now mind it, this table which is on page number 31 is specifically for the Indian NSE market, because this market is only open for 6 hours and 15 minutes. Now, if you're trading markets which are open for longer durations, then you can refer to the table which is on page number 32. You can use it for commodities, forex, cryptocurrencies, right? So again, any market which is trading for longer durations, refer to this table. But markets which are open for very short durations, you can refer to this table. So from my step number one, as soon as I opted my purpose of trade, I got to know what time frames I'll be using, plus what analysis I will be doing on each and every time frame. So my challenge number one is taken care. Now, the next challenge is, yes, I do know my time frames, but if you take the example of NSE exchange, we have over 2000 companies listed on the NSE exchange. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place for selecting few symbols or few scripts, because if I have a smaller list, I can do my analysis almost every other day, but going through 2000 symbols every day is not an easy task. So how do I get that smaller list? For this, we use certain computer programs which are called as scanners or screeners, and the way these computer programs, they basically work is that we input certain conditions into them, that these are the conditions I'm looking for, and then these scanner screeners, they identify that out of these a number of symbols, which symbols are matching with those conditions. Whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very important, always remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell these symbols. So the scanner screeners, they never tell you what you need to buy or what you need to sell. Scanner screeners only tell you, okay, from these symbols, these are the symbols which are matching with your conditions. Once you have identified them, you will have to analyze them one by one manually and see which one of them matches with your trade plan. Whatever is in sync with your trade plan, that's an opportunity for you. Whatever is not in sync with your trade plan, you'll simply skip it. So again, very important, scanner screeners, they do not tell you what you need to buy or sell. They just help you get a smaller list, which you will have to analyze manually. Now, a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on moving averages, and they can help you shortlist symbols based on these moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, if you search for sector analysis, you'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, again on my YouTube channel, if you search for top-down analysis, you'll again be able to find a video on top-down analysis, which can help you in shortlisting symbols. So these are 3-4 different examples of different scanner screeners, but you're not restricted only to these 3-4 scanner screeners. Let's look at few examples before we move ahead. So like I was talking about, once you come to our website, under the free tab, you can see you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting 6 symbols for me. So like I already said, just because it is shortlisting these 6 symbols for me does not mean I can blindly buy these 6. So the scanner is not telling me what I need to buy. The scanner is only telling me, okay, I've shortlisted these 6 symbols for you. Analyze these 6 symbols one by one and see if any one of them matches with your trade plan. If any one of them matches with my trade plan, that's an opportunity for me. If nothing matches with my trade plan, I don't have any opportunity for today. Similarly, if I go to the short scan, you will see the short scan is not shortlisting anything for me. So this can happen at times. Your list can be a very small list, like you can see today, or maybe nothing is getting shortlisted because nothing is matching with these conditions. So now the challenge is that the smaller the list, the lower is the probability you might be able to find something which is in sync with your trade plan. So if you want that my list should be a little bigger list so that I can go through more number of symbols to identify my opportunities, then what you can do is you can see that in this scanner, I have given 5 different conditions. You just disable the third one, run the scan again, and I'll do exactly the same thing for the short scan, disable this and run the scan again. And now you can see that initially it was only shortlisting 6 symbols for me, but now it is giving me a list of 110 symbols. And if I go to the short scan, it is giving me around 19. So I got about 129 out of 2000 plus. So 129 is not a very big number. I'll say probably if you have to analyze 129, can be easily done in about maybe half an hour, 45 minutes to the max, maybe in an hour. So it's a decent, small enough number to analyze. But yes, if you still feel it's a very big number and you further want to filter it out, then you can apply different filters. Example, I can say I don't want all these symbols from the cash segment. I only want the symbols which also get traded in futures. I can run the scan again. Now you can see out of 110, we are down to 28, right? So now I have a smaller list. So you can make this list bigger. You can make this list smaller by using different filters. And plus, if you go to the screener section on this website, you can see you have over 150,000 scanners available on this website. So, the 3-4 examples I showed you are not the only scanners. Here you can see you have over 150,000. Some are based on fundamental analysis. Then you have your top loved. Then you have your scanners based on candlestick patterns. Then you have your range breakouts. You have your bullish scan. You have your bearish scan. Then you have your intraday bearish, intraday bullish, crossovers. So you have a number of scanner screeners available to you, and all these scanner screeners will throw different results for you. And like I already said, scanner screeners, they never tell you what you need to buy or sell. You're just trying to get a smaller list, whatever you feel is the best fit. Using that, you can get a smaller list for you. And this is not the only website. If you do a Google search, you'll be able to find a number of websites with a number of scanner screeners, and using that, you can get your list. So now in this example, you saw we got a list of about 129 symbols. Now, once you start analyzing them, few more challenges which you will eventually face, and what are the solutions to those challenges, we'll also talk about it. So challenge number one, what you'll realize is that once you go through this bigger list, majority of the symbols in this list, they don't have a quality demand area or quality supply area on the lower time frame. And if you don't have a quality zone, you don't have a tradable opportunity, right? So the tradable opportunity only exists if you have a quality zone against which you can lean, right? But if you don't have a zone, you're basically wasting your time analyzing those symbols. So that is challenge number one, that you might be wasting a lot of time analyzing such symbols where no quality demand supply zones are available. Now, the second issue is that even if you have some quality demand supply areas, those demand supply areas might be far away from the current market price. Now, what is going to happen, because they are far away, and as a demand and supply trader, we only trade based on retracement. Whenever the prices, they retrace back to our demand areas or supply areas, that is the time we participate in the trade. So unless and until the prices will come back into the zone, I have no choice but to wait. And during that waiting period, whatever price action develops, what might happen is it might disqualify the trade setup by the time it is back into your zone. So yes, your waiting period can be really, really long. Plus, by the time prices are back, those trades might also get disqualified. So these are some challenges we face when we are shortlisting symbols based on fundamental analysis or conventional technical analysis, or maybe I'm creating my random list of symbols because those are the symbols I'm interested in. Now, to overcome these challenges, I have also created two custom built tools. So one is called as the alert service. The other one is the screener. Again, minded, these are not call giving or tip giving services. These are also scanner screeners. Only difference is that these two scanner screeners are purely based on demand supply zones versus conventional technical analysis or fundamental analysis. Now, to understand them better, you can go through the walkthrough videos. The links are available in the description, but just to help you quickly understand what these two basically tools they do for us. So the way alerts basically work is that alerts are based on the zones which are getting formed on the current day, right? So whenever you are in a live market, as and when the demand and supply zones are getting formed, it keeps notifying you real time. So we do have demo channels for NSE, for MCX and Forex. So here you can see I'm showing you screenshot for the NSE demo channel, which was from 6th of September. And you can see that these alerts we give you for about half an hour during the trading session. And for the NSE, we give it from 11:15 to 11:45. So you can see 11:15 Zydus Live. We have a drop base drop on the 15 minutes time frame. This is the proximal value. This is the distal value. Then you have 60 minutes alert, 15 minutes alert, 60-minute alert, daily time frame alert, 15 minutes alert, 5 minutes alert. So you can see as and when these zones are getting formed, you get real time notifications that on this particular symbol, on this time frame, we have a formation of a demand zone or a supply zone. Now, very important, just because you have a demand zone or a supply zone formation does not mean you can blindly trade it. The job of the scanner was to tell you where these zones are getting formed. Now, when you have the information, okay, this is where the zone has formed, you will have to qualify that zone with your trade plan. If it qualifies based on your trade plan, you have an opportunity. If it doesn't qualify based on your trade plan, you simply skip it. So that is what alerts is. They keep notifying you as and when these zones are getting formed. And talking about the screener, the way the screener basically works is that we can input our list of symbols. So like here you can see I've input my list of about 40 symbols. Now I've just applied the screener to one chart, right? I can have multiple chart layout. I can apply it multiple times. I can have a list of n number of symbols I wish to. But yes, this definitely is also linked with whether you have a free trading view account or a paid trading view account, because on a free trading view account you can only add 2 indicators and you cannot have multiple chart layouts. So that is where you'll have some limitations. But if you have paid account, you can have multiple chart layouts. You can apply the indicator multiple times. You can have a number of templates as well, and you can have a very big list. So here you can see after giving the list of 40 symbols, I have given my settings that I want my proximity to be 1%, which means out of these 40 symbols, on whichever symbol the current candle is within 1% to a demand area or a supply area, shortlist it for me. So now you can see if I'm somebody who's only looking for long trades, I only have 2 symbols which are close to demand areas, and that is why it is highlighted, and these are the ones which are close to supply areas. So just as an example, if you see Asian Paints will be having proximity to both demand as well as supply. If I go to ASIAN, Asian Paints, you will see we have a rally-based rally demand area. That is why it got shortlisted for us. And you can also see we have our supply zone sitting right above. That is why it is also shortlisting it for the supply side as well. If I go to Bharti Airtel, you will see on Bharti Airtel will be closer to a demand area, and here you can see we have a rally-based rally, and that is why it got shortlisted for us. So let's give the indicator a few seconds. So now you can see it. And similarly, if I just change my time frame, let's say to weekly, now it will give me the list based on the weekly time frame. So it will tell me on the weekly time frames on which symbols I'm closer to demand areas and supply areas. So example, if I go to Infi now, you will see on Infi will be closer to a demand zone. So here you can see we have a rally-based rally. We're trading pretty close to it. So this is what the screener does. It helps you identify symbols where you are trading closer to the zone. In fact, if you want that I only want these zones where symbols where I'm trading inside of a demand area or a supply area, we can also tweak that. So just as an example, I can say, because we need to be inside, I want tested zones, and to be inside, it has to be 0%. So now you will see it will give me the list of symbols where the current candle will be inside a demand area or inside a supply area. So let's give it a few seconds to refresh. Can you see it's working? Because it has to go through all those 40 symbols, the complete charts, all the zones, and then identify where we are trading inside of a demand area or a supply area. In fact, if I want to make it faster, maybe I can just shift to a weekly time frame just to show you, or we have already given it some time. Let's wait for a few seconds. Once it refreshes, because a lot of data it has to analyze. So let's wait for a few more seconds. So now you can see it has shortlisted quite a few symbols for me. So if I just go to the very first one, Hindalco, HINDAL, so you will see that on Hindalco, currently we will be trading inside of a demand area, and that is why it got shortlisted for us. You can see we have a demand zone, we are trading inside of it. So yes, this is how you can tweak it based on your preferences, whether you only want the zones which are fresh and you are closer to it, or whether you want zones where you're probably getting closer to those demand areas, supply areas. Choice is yours. It can be tweaked based on your preferences by using different settings. Alright, so now that we have talked about different ways of shortlisting, whatever you feel is the best fit for you, based on that you can shortlist symbols for you. And the process can also be as simple as, I don't want to use any of these scanner screeners. I want a small list. I will only be analyzing my Nifty 50 stocks. or maybe I have my own favorite list of stocks which I might want to analyze. So choice is yours how you want to get that list. But once you have that list, you're now ready to move ahead because you know what time frames you will be analyzing. We got to know that from our step number 1, monthly, weekly, daily, and 60. Plus now I also know which symbols I need to analyze. So what we do is we start analyzing them one by one, and out of this, whatever matches with our trade plan is an opportunity. Whatever doesn't match with our trade plan, we simply skip it. So let's assume I got a list, and in that list, the very first one was ABC. So what I need to do now is I need to go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame will be the daily chart. So here we'll go to the daily chart, and on the daily chart, we'll try to identify zone. So if I go to the chart, you can see as if now I have the demand supply zone indicator applied. So I don't have to analyze and identify the zones manually. The indicator is doing it automatically for me. But when you started learning demand supply methodology, we talked about process which is boring and exciting technique. Now, first thing you need to remember is that demand supply methodology is price action based. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. It can either move up or move down. It cannot do anything else. But when price is moving in a very narrow range, we call it as the period of pause, or we can also call it as our basing. Now, initially, when we start learning demand supply methodology, and let's assume I'm not subscribed to the demand supply zone indicator because it's a subscription based indicator. And since I'm not subscribed to it, I still want to train my eyes how to identify these zones. So we start with a concept which is called as boring exciting technique, because you will see majority of the zones can be identified based on boring exciting technique. But as you start having more and more experience, you need to understand that demand supply is not based on boring exciting, it is based on price action. It's just that since majority of the zones can be identified by using boring exciting technique, we use it as a starting point for us to start training our eyes. Now, the boring candle indicator, which I've created on TradingView, is an absolutely free indicator. You can use it for free forever. Similarly, the explosive move indicator is also a 100% free indicator. You can use it for free forever. So these two indicators can help you in identifying, in training your eyes to identify these demand and supply areas. And as you start having more and more experience, eventually you'll have to shift from boring exciting towards understanding the flow of the price, which is the price action. And the demand supply zone indicator is purely based on price action. Based on the flow of the price, it identifies the demand and supply areas for us. Plus, if you go to TradingView indicator section and search for demo demand supply zone indicator, you'll also be able to find a demo version which you can use. The limitation of the demo version is it can only be applied to the daily time frame. You cannot use it on any other time frame. Plus, it also has limitations like you cannot do multiple time frame analysis on all those things, but at least you will have the indicator to try it out to see how it identifies the demand and supply areas for us. So here you can see the indicator is telling us we have a drop based rally demand zone for us. So let's mark this demand area. So my step number 3 is now done automatically by the indicator. It has identified the demand area for me. So that takes care of my step number 3. Now, once I have identified the zone, so is the zone available? The answer is yes, we do have a zone available. And this is where demand supply traders initially they make the biggest mistake. And that biggest mistake is they find any demand area, blindly start buying on it. They find any supply area, blindly start selling on it, which is incorrect. Once the zone has been identified, the next step is to qualify it. And for qualification, we have a 2-step process. In step 1, we'll qualify it based on certain conditions. And in step 2, we'll qualify it based on the booster scoring. So the very first thing we'll check is that the zone we have identified, can it be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. That is why we start with level on top of level. And how do we verify it? It's a very simple concept. If you have an intermediate time frame zone and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. Now, to be a case of level on top of level, the first criteria would be my lower time frame has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level. But if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that the zone I have identified, does it coincide with any intermediate time frame zone? And if I go to the weekly chart, here you can see again we have a drop based rally structure. So let's mark this. So what I'll do is I'll mark the intermediate time frame zone with a different color, which is pink, and the lower time frame zone is marked in green. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which means this is a coinciding level. But along with coinciding, do we have multiple zones? Now, this is a very good example to understand what we call as a coinciding level. Now, you might say, Srujit, okay, we do have one zone here and we have a second zone here, and both these zones are inside my intermediate time frame. I agree with that. But remember, what is the definition of coinciding level? The definition of coinciding level is when your intermediate time frame zone divides into multiple zones. This is where we don't have our intermediate time frame zone. This is where we have our intermediate time frame zone. So this is not a coinciding level. We only have one zone, even though this is inside of it. It will not be called as a coinciding level. For being a coinciding level, it has to be the intermediate time frame zone, which is getting divided into multiple zones, or it is having multiple zones even for the case of level on top of level. So even though yes, it is completely inside, it is not part of the intermediate time frame zone, right? So that is why it's not a coinciding level, and since it is not coinciding, we cannot call it as a case of level on top of level. So we only have a coinciding level here. So again, going back to our flowchart, it is not a case of level on top of level. The zone is not because of a gap, therefore gap rules will not apply. Pivot non-authenticity, definitely applicable, because by default we have to drop based rally and a rally based drop. We always apply pivot non-authentic rules. In fact, I guess during the last session, somebody asked this question, what is a non-authentic zone? So this is a beautiful example. You can see this zone was formed as a test of a previous zone. And can you see even this zone was formed as a test of this rally-based rally? So that is what I was talking about, that whenever you have a drop-based rally, it can be a test of a previous zone. A drop-based rally can be a test of a previous zone. And that is why whether we see these zones or we don't see these zones, whenever we have a drop-based rally or a rally-based drop, by default, we will always consider it as a pivot or a non-authentic zone. Here you can see this is definitely non-authentic, formed as a test of a previous zone. So it is definitely a non-authentic zone. So we'll have to apply the rules of pivot and non-authentic zone. So if I go to pivot rules, so we have two approach available to us. The very first one is the aggressive rule. Aggressive rule says that even before we start applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what do I mean by that? Okay, this is where I have my zone and this is where the move started from. So this move should have violated one opposing zone. So if this is demand, opposing zone would be supply. So this move should have violated one supply, but not of the same time frame of the intermediate time frame. If we see that scenario, this is qualified for us. If you don't see that, this gets disqualified for us. So if I go to weekly chart, you can see on the weekly chart, when we have this move to the upside, we don't have violation of any opposing supply area. All the supplies that we had in the past were already violated. In fact, I can do a candle replay just to prove it to you. So you can see if I do a candle replay, this is where we started moving up from. So you can see that if I draw it something like this, we don't have any supply. The nearest supply is this. So unless and until this supply will get violated, our rule number, not rule number, our aggressive rule will not qualify this zone. Now, if you are somebody who's only planning trades using the aggressive rule, so this is where the zone will get disqualified for you. So this is also a very common question I've got in the last few sessions, that how does a zone get disqualified? So let's assume that I'm a person who only applies the aggressive rule for the pivot non-authentic zone. So once I would have reached this step and I would have applied my rule of pivot non-authenticity, I would have said, okay, this zone does not qualify based on my trade plan, and since it does not qualify, I'll skip it, I'll move on to the next symbol, right? So beautiful example of how a zone can get disqualified or a setup can get disqualified. Now, I've also given you another rule, which is your conservative approach, right? So the conservative rule basically says, now why conservative? Because here we are looking at two conditions, we are not looking at one condition. Those two conditions are, first, we need an impulsive move on the intermediate time frame, which we already have. You can see my last pivot high was this, and when we got this move, we definitely breached this high and created a new high. So we have an impulsive move. And the second condition is that on my refining time frame, I need an authentic zone. Authentic zone means I need a rally based rally. So if I go to my refining time frame in this case, which is the daily time frame, you can see here we do have this rally based rally structure, which the indicator will mark for us in just a few seconds. You can see we have that rally based rally structure available to us. So yes, if you are applying the aggressive rule, based on the aggressive rule, it is not qualified for us. But if you apply the conservative rule, absolutely qualified for us. And the last one is unstable equilibrium, which is not applicable. So if you look at, let's say I'm a person who's always applying the conservative rule, then based on all these conditions, this zone is qualified for me. I have the green signal to move ahead. So after applying all the applicable rules, is the zone qualified? The answer is yes. Now, once the zone has been qualified, again, does not mean I can blindly trade it. The next step will be to do my booster scoring. So let's get started with the boosters. First one is freshness. The zone is definitely fresh, gets a score of 3. Strength. Now, what I generally do is, because I only trade MIT trades, on the daily time frame, since I'm using a bigger time frame, even for a single leg out, I keep my setting as good, right? If I change it to explosive, you will see this is not an explosive move. The indicator is not marking it. But since it is a good move, I can give it a score of 1, right? So that is one thing which I do. Now, if I'm doing anything which is below the daily time frame as my lower time frame, then I'll always keep it as explosive for HITs and DITs and even for WITs. But for MITs, because we are leaning against bigger time frames, I don't mind keeping it as good for a single leg out pattern. Now, time at the zone, we need minimum 3 candles to give it a score of 2, which we already have. Reward to risk we are taking as an assumption. However, you can see we do have an opposing zone right here, which as if now is not showing us a 2:1. So currently, based on this as my opposing fresh zone, I don't have a good reward to risk ratio, which again disqualifies the zone. But what can happen is prices can move up, test it, and then start coming back, which is where this will no longer be our target. Then we'll be looking for the next supply area, which can open up the reward to risk ratio. Second thing which can happen is prices can violate the zone and then start coming back, which is again where this zone has no meaning for us. And the worst case scenario is if the prices they straight away come into the zone, then this being my nearest zone, I will not be having a good reward to risk ratio on this one. So yes, next thing is, so currently we are taking it as an assumption, but yes, at the time of arrival, we'll have to verify whether we have the required R or not. Now talking about the location, we do have demand area, but we don't have any supplies. So we have taken such cases a number of times in the past. We'll take the recent pivot high and all the way to the demand area, and now you can see we are planning our trade low on the curve, which is a good location to plan a long trade. So we are at a good location, gets a score of 1. Trend, you can see the indicator is telling us we are in a sideways trend, gets a score of 0.5. Move from the zone, we need at least 4:1, which has not yet happened. So if we draw from the entry to the stop loss back to the entry, you can see we just have about a 2:1 move. So currently a score of 0, but eventually, yes, if the prices they move up and then start coming back, it can be upgraded to a score of 2. Not a case of level on top of level, definitely coinciding. And even for trap, I can give it a score of 1. And the reason is if I take a horizontal line here and we start pushing it up, you can see in the past, almost this area has been working beautifully. Like you can see here, it worked like support, almost work like support. Then we have resistance, we have resistance, we have resistance, we have resistance, resistance, resistance. Here also beautifully acting like resistance. So people who believe in support and resistance would have already bought considering it as support. And now since the prices are moving above this, they will be more interested in selling, which will also be their stop losses. They might be exiting their positions. Plus we also have this breakout, and people who believe in breakout will also be selling. So by the time we are into this demand, we'll have a lot of selling coming in by the virtue of stop losses getting hit for breakout traders. And these traders are now making two novice mistakes: selling after a decline in price, which means selling at a cheaper price. And in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So yes, we do have a setup which might work like a trap, due to which we'll give it a score of 1. So if you look at the overall scoring, we have a score of 9, which makes it as a high quality zone, and 3.5, which makes it as a low probability zone. So high quality, low probability can only be done as a type 2, type 3 trade. So going back to our boosters, to the flow chart, after applying the boosters, we got to know this is only qualified as a type 2, type 3 trade. Now, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we need to be ready for the worst case scenario. So what we'll do is we'll do our position size calculation, so that in case it doesn't go in our favor, it goes against us, we should not be losing more than what my risk management rule allows me to lose. Whenever the prices are back, we'll re-verify, because markets are not static, they are dynamic, conditions are changing almost every other second. So we'll have to re-qualify that. Does it still qualify based on my trade plan? If the answer is yes, we place our order based on the entry type, in this case type 2 type 3 trade. And once your order has been executed, the last step is your trade management, where step 1 is to 1, we'll make it break even. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based. And that's your example for today's session. And yes, now before we get into the questions, which we have quite a few questions in the chat box, let me add, if you people are liking these sessions, do hit the thumbs up button, do like the video. And if you have any friends, family members, or if you're into some trading groups, you can also share the link to these videos to my course content on those groups with your friends and family, so that people can take advantage of this methodology. And yes, now let's see what do we have in the chat box. So the first question is, can I use wick to wick for supply zone and border to wick for demand zone in the same symbol? See, ideally what we should be doing is, whatever we are following for demand, we should be following the same thing for supply, right? So if you're doing wick to wick, do it both for demand and supply. If you're doing it border to wick, do it both for demand and supply. But yes, if you still want to make that modification, that let's say for supply I want to use wick to wick, demand I want to use border to wick, it's your call. But generally I'll say it will make more sense that if you're consistent in both your approaches, be that demand or be that supply. Alright, so when using wick to wick method, the zone is tested, but when using border to wick method, the zone was not tested. I am a beginner, and according to the rule book, use a preferred method, which is border to wick. See, again, absolutely, when we start learning something, like I always say, we need to be a little conservative. So when we're using the border to wick method, we are being a little conservative, in the sense we are trying to bargain with the price, right? We are trying to get a deeper entry, be that a demand area or a supply area. Now, even in real world, when you're trying to bargain, what will happen is you'll miss a lot of deals. And the same thing will happen with trading as well. When you're trying to bargain, you will miss a lot of trades. So initially, yes, we are trying to get a little better price, because again, going border to wick method also makes your zones narrower. So getting a 1:1 to make your trade break even, or getting a 2:1 becomes a little easier, but at the cost of missing quite a few trades. Now, once you start getting very good with identifying your quality demand areas and quality supply areas, you will see that you will be missing a very huge percentage of trades, because once you start get good with your analysis, prices most of the times will just touch your zone and move away from them. So that is where you'll have no choice but to shift to border to wick, shift to wick method. So technically the zone always starts from the wick, ends at the wick. Border to wick is just a little conservative approach initially, but eventually you will have to shift to a wick to wick method, because if you won't make that shift, you will be missing a lot of trades. And you can see almost every example that I share with you, I'm always using wick to wick method, because if I'll shift to border to wick, we will be missing quite a few trades, right? So that is the reason I always prefer to do wick to wick. But that's just a transition which will happen eventually. It's just that initially, again, a conservative approach, we are trying to get better pricing, narrower zones, for better trade management, for better risk management. All right, so confidence in the methodology begins, more confidence, because you see the preparation you put in the plan, and it shows to see if it works or not. Absolutely. And that is the idea behind these live sessions, because see, the fact is, what has already happened, it is very easy for someone to pull up a chart, apply a number of indicators, and give you a number of reasons. Okay, this is why we could have bought it, or this is why we could have shorted it. And the reason is because what has already happened, all the indicators will show you the same thing, because indicators are being calculated based on whatever price action has happened. So that is why doing a postmortem is a piece of cake, but planning it in advance and then seeing what the outcome would be is a completely different game. And that is what I like to play, and that is the reason I do these analysis in advance, so that you people build your confidence in the methodology, and this is the only way to build that confidence. All right, so compiling a watch list can be an overwhelming task. Build a handful of numbers of tickers, and you follow and use the methodology to see if it passes and meets your trade plan. Absolutely. See, I completely agree that creating a watch list can be a little overwhelming, and the main reason is if you're using even our tools, which is the scanner, the screener, and all those things. The problem is that the very first time you'll have to manually input all those symbols, which is a task. But yes, that has to be done one time, right? It's not that you have to do it every day, but that one time has to be done. Though I'll give you a way it can be done, uh, but for that you will definitely require a little bit of understanding of computer programming. There are a lot of applications available for creating macros, right? So the task which you have to do repeatedly, you can create those macros. So the one which I use is called as pullover macros, which is open source software using which you can create a macro for inputting all those symbols, right? Though it will have its own learning curve. If you want to try it out, it's your call. I just told you a way how it can be done. That is what I use. Now the question is, now some of you might say, Ki, why don't you share that macros with us and we can straight away use it? It's not as easy. The reason for that is because that macros is basically created based on my screen resolution, right? Different people will have different screen resolution where it will not work because, we are giving the coordinates for x-axis, y-axis, which will change based on the screen resolution, based on your screen sizes. So that is why it's not simple as that I just share it. You'll have to create it for yourself. But yes, you do have an alternative. It will take some work, but if you want to try it out, I just told you the name of the application. I'm telling you for Windows because I use it on Windows. I'm not sure whether it is available for Mac or not, but for Windows, it's called as pullover macros. You can try to create a macros to input those symbols, which can make your task a little easier if you wish to. Okay, look for candidate that meets with your criteria, stick to your plan, execute it, follow the flowchart, and things will be simplified. Absolutely. And the fact is, if you don't have a simple trade plan, trading anyhow becomes very complicated, right? So you have to always keep it simple. The simpler it is, the easier it is to execute, and that's I'll say is a very important factor, because if you have too many things to look into at the time of execution, it will lead to over analysis. That leads to paralysis, right? That is what is going to happen. All right. When checking for validation of rules to see if the zone is qualified, do you need to qualify zones or all zones in general? See, whenever we are talking about qualifying a zone, we are always talking about qualifying the lower time frame zone. Why? Because that is where we will be entering into the trade. We have nothing to do with the zones which are on the intermediate time frame or on the higher time frame. Those we don't have to qualify. It's it's always the lower time frame zones we need to qualify, because that is where we are entering the trade, right? That is what you need to do. All right. So great content. All right. Thank you so much. And I would be so again. These sessions you can keep attending, and that is how you will keep gaining understanding, better understanding of demand supply methodology. When running into a given scenario in the chart, please cross refer to the rulebook, which makes easy to see the. So that is yes what I always try to do. Like today also, when we were applying the rules for pivot and non-authenticity, I showed you both the rules in the rulebook. So I always try that wherever we are applying, I'm always referring back to where it is available in the rulebook. So I always try to take care of it. Does the meaning of authentic zone is a zone? No, authentic basically means a rally based rally and a drop based drop, because as we talked about, a drop based rally and a rally based drop can be test of previous zones, right? For them to be test of previous zones, the probability is very, very low, right? So that is why rally based rallies and drop based drops are always referred as authentic zones, and drop based rallies and rally based drops are your non authentic zones. Nothing to do with the number of candles. Number of candle can be 1, 2, 3, 4, 5, 6, whatever, but it's basically the structures, right? So these are the two demand structures: rally base rally and drop base rally, and these are the two supply zone structures: the drop base drop and the rally base drop. So these two are called as continuation patterns. Why? Because the leg ins and the leg outs are in the same directions. These two are also called as your reversal patterns, because your leg ins and the leg outs are in the reverse direction. So these two are referred as non-authentic zones. These two are your authentic zones, right? So I hope that helps. So using wick to wick, the entry and triggered and price moved, but using the same body to wick method when the prices come back, I was stopped out. What to do? See, again, if you are expecting that there is a methodology where you will not be getting stopped out, then you'll never be able to find such a methodology. You will be getting stopped out. But again, if you now think about it, like I was talking about, that once you start getting better with identifying your zones, most of the times prices will just touch your zones and move away. Now, if you're doing body to wick and the prices are going a little deeper into the zone, in a way that could also imply that it might not be a very high quality zone. That is the reason prices are going deeper into it. So that is also something you will realize eventually, that when you're trying to get a better price, the zone might also not be a very high quality zone, due to which the prices are also going a little deeper and giving you the entry, which also increases the probability of stopped out trades. But that does not mean that for a wick to wick method you will never get stopped out. Wick to wick also you can get stopped out, body to wick also you can get stopped out. But yes, if the prices are going deeper into the zone, that is also one of the indication it might not be a very high quality zone, due to which prices are going pretty deep into it, right? But yes, in both the cases, it can be a stopped out trade. I've noticed that most of the trades you have shown in the live sessions are long trades. Can you show an example? See, the reason most of the trades, I won't say most of the trades, I'll say 100% of the trades that I've shown are long examples. And the reason for that is I'm showing you the examples from the NSE market. And as per the Indian Stock Exchange, which is NSE, we cannot have a short trade in cash market and keep it overnight. So what happens is, if you are planning a short trade strictly has to be an intraday trade. The only way we can do a short trade as an overnight trade is by either trading it in futures or trading it in options, which I don't do. Since I only trade in cash, I have no choice but only to plan long trades. And that is why you will see that all the trades that I share with you are always long trades. That's the limitation, based on the markets I'm trading, based on the asset classes I'm trading, because I'm not doing futures, I'm not doing options, I'm only doing stocks. So I can only plan long trades as MIT trades, because longs are the only positions I can keep overnight. Shorts I cannot keep overnight as a stock trader in the Indian stock market. So that's the reason all the trades I'm sharing are long trades. But again, whether you're planning a long trade or the short trade, the analysis will remain the same. Nothing is going to change, right? So don't worry about that. Okay, please spread the word about free course. You will definitely learn a great deal and will improve. Okay, so probably that's a message, that's the message for people who are joining in live. There was a video in which in your channel with free options indicator HVIV. Could you give a way of indicator? Are you still doing the giveaway? The video was. See, the HVIV indicator is now an absolutely free indicator, though you cannot have right away access to it. To have access, you will have to send an email to info@surjitkakkar.com. So just send an email to info@surjitkakkar.com with your TradingView username that you need access to the HVIV indicator. Once we get your email, within 24 hours, it will get activated for you, right? So it is an absolutely free indicator. It's just that it's an invite only symbols, it's an invite only script, so you'll have to send us a request on info. Again, email address is infoinfo@surjitkakkar.com. Just send an email with your TradingView username. Just ensure you're sending the correct TradingView username, and just put a request that you need access to the HVIV indicator. Within 24 hours we'll activate it for you. All right, so that takes care of today's session on all the questions, queries we had in the chat box. So I hope this session was helpful, and I'll be seeing you next Sunday. Till then, stay safe. Enjoy your Sunday. Take care. Bye bye.